I'm David Begg, and from Impact Alpha, this is an Agents of Impact podcast.
Even if something is capital intensive, it doesn't necessarily mean it has to be super equity intensive. You can still remain equity light while being an asset or capital intensive business over time.
That's Russell Sprole of Virta Ventures. I caught up with Russell to talk about why Virta has expanded its equity-light, software-focused climate tech investment strategy to include hardware, AI, and blended capital stacks. Virta has been an active and early user of ImpactAlpha Edge, ImpactAlpha's premium platform of data and tools for fund managers and other agents of impact. Let's jump right into our conversation. Russell Sprole, welcome to the podcast.
Thanks, David. Great to be on.
Congrats on closing your first fund. We've been tracking Virta Ventures for a while. What? No rest for the weary. What are you up to next?
Yeah, we're at the tail end of deploying Fund One and continuing to grow and build the platform. Continuing to support those 29 companies from the portfolio, Fund One portfolio, and we'll be investing in more later this quarter and continuing to grow the platform.
In the world of early stage climate tech, I remember the first fund had a thesis around equity light, and I think mainly software. I know you've expanded your focus a little bit. Tell us how you're thinking now.
Yeah, absolutely. When we launched Fund One, it was actually right before the first ChatGPT launched, and we've seen the world change very dramatically ever since then. And ultimately, and there's multiple posts a day on this on LinkedIn and elsewhere, how AI is reducing and certainly changing the moats and defensibility of pure software businesses. So that's one driver of evolving our thesis. Additionally, we invested in a handful of great hardware companies in our first fund, and when you're investing in energy mobility in the built world, you typically have to get your hands dirty to create and capture value. There certainly are some more software AI focused plays that can be pure software, but we believe that a lot of the businesses and business models that can become and will become really, really big will have some physical component to them, or at the very least a financial layer, insurance layer. And so we're continuously looking for those innovation stacks where a company will layer on software and data and network effects and financial products and perhaps hardware to create and capture value. We see a increasingly robust capital environment for businesses in our sectors, and the more capital intensive businesses that are smart about financial engineering and figuring out how to layer on other sources of capital that are lower cost, less costly than venture capital and equity. We believe that the best founders are going to be great financial engineers that can bring the variety of capital sources to bear and minimize dilution and ultimately be equity light, even though they may be asset heavy and capital intensive. They can layer on revenue being the best one, but grants and debt, project finance, asset-backed lending, asset-backed financing, corporate debt. There's so many different capital sources out there, and many of those pockets are increasing in magnitude and availability. And so that last piece is critical, that even if something is capital intensive, it doesn't necessarily mean it has to be super equity intensive. You can still remain equity light while being an asset or capital intensive business over time.
That's all super interesting. Let's unpack that sort of one piece at a time. But just start so folks know what we're talking about when we're talking about early stage climate tech and the death of software, as it were. It used to be that software was eating the world, and then I guess AI ate software. How does that play out specifically in climate tech?
Yeah, I mean, there's so many sectors within climate tech. We're particularly focused on energy and mobility in the built world, and those are huge sectors in and of themselves. I mean, you said the death of software. I'm not quite so bearish. I do think there are still opportunities to build enduring businesses that are software centric and software focused, especially if you're moving fast and leverage AI in compelling ways. But within the sectors that we invest in, there are only there are fewer opportunities, I would say, than many other sectors to be software only. And oftentimes you will need to, again, have a physical layer to your product, whether that's a service or a hardware or other layers of an innovation stack, financial products, insurance products. A great example from our portfolio is a company called Tyba. They started as a more software centric company, helping dispatchable energy assets optimize, maximize revenue. And over time, they're going to be layering on a trading platform, layering on, boots on the ground, physical services, and building out more of an innovation stack that is not pure software. And I think that will be critical to their long-term success of owning a big slice of that market.
So it sounds like there's a product stack, like you say, that ranges from software to hardware to services and marketplaces. And then you've also described a sort of financing stack that kind of goes along with it. But maybe take them one at a time. Type is a great example, but you're saying that you can start with a software value prop, and then but in the energy world, you want to actually get to real things that consume real energy.
Oftentimes, yes. Again, not exclusively. I think it depends. It depends on the subsector, but usually you're going to need to have some physical component or financial component or insurance component to your business in these sectors. It's hard to be pure software. And again, that may be operational, that may be services, that may be hardware. It really depends on the underlying business, but there's not that many opportunities that we see to be pure software. Though there still are some, and the best teams that are building that software, we think, can still build really big businesses.
I think some of your perspective, as I understand it, comes from your own operating experience, and you help founders, as operators as well. They're navigating this extremely complicated environment now, but it's not only AI. There's shifting climate policies and all the rest. How does your founder and operator experience bear out?
Yeah, absolutely. I mean, ultimately, I lean on that operating experience every day. I mean, ultimately, I'm building a company and a firm, so that it starts there, and then the network that I've built from 15 years as an operator and entrepreneur continues to be really robust and help generate sourcing for the fund. And then I think in terms of diligence in helping understand the people and the business models and the businesses, always looking back at my operating experience and taking learnings from that as I diligence the people and the markets and the businesses. And then probably most importantly is on the support side, leaning in and helping founders navigate the pitfalls and the challenges of early stage company building, which I've done a number of times and have a lot of learnings from both successes and failures along the way. So we're trying to leverage that. I'm trying to leverage that operating experience across every element of building the firm.
And it's not just you. I understand you got a network of coaches and mentors to work with the entrepreneurs as well.
Yeah, so we have a number of ways that we're supporting, coaching being one of the core things that we're doing, and I'll touch on that more in a bit. We also have venture partners and operating partners that are helping on specific industry verticals, and specific industry expertise as well as technical expertise. So we have three PhDs, as well as an AI software expert that help on both diligence and company support. So have a number of resources to bear there, and then we've also built this, as you mentioned, this network of uh, great founder coaches, executive coaches that we look to introduce to our founders, sometimes even before we invest, but if not, after investment, and help connect them and build these founder coaching relationships, which we believe are incredibly valuable even at the earliest stages. Not that many early stage founders have great coaches, and we think it can be really game changing in terms of helping them navigate the early challenges of company building and co-founder conflict and investor conflict and managing their own stresses of being in a startup world. We think that coaching can be really valuable, and we've already seen it firsthand with our Fund One portfolio. Over 60% of the founders have coaches that most of which we've helped connect them to, and it's been really valuable to help them continuously level up and hopefully grow themselves faster than their companies grow. Because if the company starts growing a lot faster than the founder, usually things start breaking pretty quickly.
Well said. And I want to return back to the financial engineering because it's a skill set of its own. Just like the design and the technology and the product stack, and the world that you're asking founders to navigate now from debt, but also to government grants and other kinds of grants. And there's a whole art form of that, of putting together the right capital for each company. So what should founders know about sort of arranging their financing in this new landscape?
Yeah, I think the thing that I look for at the earliest stages is that founders are just aware, and they understand that there are lots of options. And if you have, frankly, any type of hardware product, but the more capital intensive that hardware product is, or the business model in general, whether it's hardware or something else, the more savvy that a founder needs to be about how they're going to fund that over time. And if somebody's building a more capital intensive business and they don't have any clue about that stack, that's usually a red flag at the early stages. Now, do they have to have every penny accounted for over a 10-year time horizon? No, but they should be aware of what's available, what's in the market, how the market's evolving for capital, and have at least a blueprint of how they're going to um, how they're going to grow their business and where they're going to get their capital over time. And hopefully, it's not all corporate equity, because that's going to be very dilutive to me.
That's what I was going to mention. You like the non-dilutive capital as much as the founders do.
Yes, of course. We don't want them to be diluted, and we don't want to be diluted that much. There'll certainly be some dilution, but it also, you can't just throw on layers of debt that are going to bankrupt the company either. You really need to be thoughtful about how you create that capital stack and have non-recourse funding that's at a project level versus a corporate level. And there's an infinite number of ways to layer on these different capital sources. And just having a good sense at the early stages, and then being very, very thoughtful as you actually execute on it, is critical for any founder in the worlds that we're investing in.
You talk about the capital marketplace, and the obvious question is, in the world as it is, with policy reversals and such things, and also geopolitics being what they are, what is the capital marketplace now for climate tech, and have we come out of the sort of venture recession of the recent years in terms of allocations and things?
Yeah, great question. Ultimately, we've been very focused on from the beginning on companies that don't heavily rely on subsidies or policies, especially at the federal level, which I've seen over my career come and go every few years. And obviously, that's happened in the recent past, but it's been happening for decades. So there's really no change there, though may have felt more painful recently. We've tried to steer clear of companies that are heavily reliant on that, and more so focus on businesses and business models and technologies that can stand on their own. And so far, that's working out pretty well. I will say, though, I mean, we have a couple companies that work directly with the government, and kind of similar to my answer earlier on knowing about the capital stack and having a view on how to navigate that. If you're going to be working with the federal government, you better have a pretty good sense how to navigate that, and have the connections, have the wherewithal, to do that effectively. And we've seen that done well in the portfolio. And whenever looking at a company that requires that, we're going to diligence that piece of it very, very closely.
So-called stroke of the pen risk, I think people call it.
Yes, yes, and to the extent that we're investing in something that is working directly with the federal government, we try to back things that we believe will be enduring in any uh, any cycle, any policy, any party in office. And we've for example, we've backed a few things in nuclear. that we think will endure in that way. And they may be getting government contracts, but they're not getting, they're not necessarily getting tax breaks or subsidies. They're getting, the government may be a key customer, a key partner, but if it's market based, market based contracts, that is something that we believe can endure and has less risk long term, even as parties come and go and at the various state levels of the political scene.
Now, what about the capital marketplace for fund managers and GPs like yourself? So you endured the trials and tribulations of being a first-time fund manager, successfully raised and deployed that fund. Now you're a second timer or an old timer, maybe. Does it get easier?
Um, Hopefully, I think it'll get marginally easier each time, but it's never easy. It's always a grind. Raising capital, whether you're a company or a fund, is typically a challenge. There's a few funds out there that just have to raise their hand and the billions come, but most managers in any market, whether it's in the energy and climate space or other markets, we need to work hard to find the right capital partners, the right LPs to build a long term and enduring capital base on that side. So I think it will always be a challenge to varying degrees, but it's an exciting one, and I'm excited to continuously build and grow the LP base and find the right long term capital partners that can grow alongside me over the next decade and more.
All right, let's leave the listeners with a couple or three trends or themes they can take away and impress their friends with. What's exciting you in the climate tech landscape now, in a general sense?
Yeah, absolutely. Share a couple things and then maybe one hot take. So, one thing is I'm very very bullish on electrification of transportation more broadly, even though there are some headwinds, and I think autonomy is going to be a huge driver of electrifying faster than people may expect. I haven't seen any, at least not consumer cars that are autonomous and non-electric. I think all autonomy is going to be, especially at the consumer level. Trucks a little bit different, but at the consumer level, at the passenger car level, autonomy equals electric. And I think those two trends are going to explode over the coming decade. And if you've been in a Waymo, you know what I mean. It's just a fundamentally far superior product and experience. The second thing is resilience and affordability, which go hand in hand. Lowering the cost of electricity, lowering the cost of insurance, lowering the cost of building and operating homes and buildings is a mega trend that I think will last for decades to come. And that's an area that we still believe is highly underinvested. And there's a lot of opportunity there. And I think more and more capital providers are starting to see that. And then the last thing, which is a bit of a hot take, is there's still a lot of buzz around data centers and energy around data centers, and there's clearly a massive opportunity for infrastructure to be built around that. And I do see a lot of companies building solutions around that, though I don't think there are many venture backable investments to be made. I think there have been plenty of innovations already over the past few years, and there will still be more. But I think it's in some ways an overcrowded space. There's already a lot of solutions out there, and if I was to bet on the next few years of deployment for us at least, I don't think we're going to see a ton of investments in that space. At least not more directly. I think many of the venture plays have been done, and there are still some areas that I think are underserved, but by and large, I think that space has been overserved by both companies and capital over the past few years. And now it's time for the infrastructure dollars to take hold and go build those data centers and the power sources.
Well, Russell, thank you so much. I think we've got some takeaways. You can be asset heavy, but still equity light. Stack your capital in a good way to reduce Russell's dilution, and stay away from data centers, but lean into electric vehicles and autonomy. So, Russell Sprole, Virta Ventures, thank you so much for joining us. We'll be watching closely.
All right. Thanks, David. Be well.
That's going to do it for this Agents of Impact podcast. Big thanks to Russell Sprole and Virta Ventures, to our producer Isaac Silk, to the whole team at ImpactAlpha, and to all of you Agents of Impact, with gratitude for all that you do.